Hey everyone, how's it going? Welcome back to this educational video about what is capital partitioning and why is it important to your trading journey and career. Now let's talk about capital partitioning. It is a risk management for consistent traders to utilize to be more sustainable in the long run. When I explain what exactly does that mean, to simply put it into words, it is basically dividing your trading account capital into different accounts, either two or three, or depending on your situation, to basically hedge the risk. And what's the point of doing all this, you may ask? Well, with leverage, a consistent trader does not require need to have all their trading account capital into, say, let's say, into a forex trading account. Instead, they can actually divide that up to reduce the risk and also utilize the other money for other investment or other situation. So let's take a look at scenario here. And again, your capital doesn't need to be 100,000 in order to do this. You can capital to be 10,000, 1,000. Doesn't matter about the size. It's giving you different possibility and different scenarios. So let's take a look at one scenario here. So let's say you do have 100,000 in your trading account or trading capital, and you decide to capital partition that 100,000, meaning that you're dividing that up into two. So basically, you have $50,000 into a trading account, and you have the other 50,000 that is available to you. So for a consistent trader who understand risk management, understand trading psychology, and will not overtrade, over risk, or revenge trade, and it's best in that consistent trader's interest to divide the money up into different account or into something that's liquidable, such as saving account, or maybe in stocks or buying shares, something that's liquidable, meaning that you can right away get that cash out into available to divide it to deposit back into your trading account if that's needed. So scenario one here, if you can see, if you have 100,000 trading capital and you want to divide it into two accounts here. So basically you have 50,000 into your trading account and you have the other 50,000, let's just say you put it into a saving account. So you would want to trade this entire $100,000 trading capital as if you are in one account. So what does that mean? So because I have 50,000 in one account, if I want to risk 1% of the $100,000, that means it give you $1,000 per risk, which is 1% towards that 100,000. Then because I divided my account into two, so in my $50,000 trading account, what I will do is I'm going to risk 2%. I'll risk 2% on that $50,000 account because 2% of 50,000 still equals to $1,000. And that means that I will still risk 1% of my total trading account capital. You'll wonder, why do people do that? Well, there's a few reasons. First, um, you basically hedge your risk because you don't have to have all your eggs in one basket, right? You can have the other $50,000 maybe in a saving account, or you can buy some stocks, you can buy some bonds, something that's liquidable that it can redeposit into your trading account if it's needed. That way that you balance this overall trading account size capital to the same $100,000. And judging on your 50,000 trading account, if you're making money, then certainly you can withdraw money from that trading account into your liquidable saving account again. So you're balancing this number to be basically 50% and 50%. Again, you do this to also reduce variance, right? So by having less money in your trading account, so you reduce emotional trading, reduce revenge trading, you won't over risk and you won't over trade. So you kind of help yourself to risk manage that aspect of the trading. And if for any reason you have some slippage on that trade, on that particular trade that you enter, you basically hedge that by having less money in your account to be potentially lose in that slippage. So think about the scenario two now. Let's say I still have the $100,000 trading account, trading capital, and I want to trade forex, and I also want to trade crypto. Well, the best idea is you can divide them into two different accounts. You can either choose 50,000 or 50,000, or you can divide it into a different number. Let's say in this case it is, I put 2/3 into my forex trading account and I put 1/3 into my crypto trading account. Understand this, how you want to divide up your number, how you want to divide up in percentage or ratio. It's totally up to you. There is no one way of doing this. This is just to give you a scenario where why we do this to better off to utilize our capital to a full advantage. Again, you will want to trade both accounts as if you have that full $100,000 in each account. So basically, in my $67,000 Forex account, if I want to risk 1%, which is still $1,000, in order for me to risk $1,000, I'm basically risking 1.5% per account. So that means that 67,000 times 1.5%, it gives you about $1,000. And in my $33,000 account in crypto, I would have to risk 3% now. And then 33,000 times 3%, it gives you about $1,000 as well. So you would do that on each of the position that you want to enter in those forex in those accounts, and you will want to balance these two accounts on a monthly or quarterly basis. Balancing meaning that if your forex account is increasing, then you would naturally want to withdraw some money and deposit back into your crypto trading account so that you still remain a two-third and one-third kind of ratio balance. Or if for any reason your crypto account is losing money, what you need to do is to withdraw money from your forex trading account and then deposit into your crypto trading account to remain that balance that you want to see. Again, this is exactly what I mentioned about in scenario one, is you're doing this to allow yourself to leverage your total trading account capital, right? Instead of having $200,000 that you put 100,000 in forex trading and you put 100,000 in crypto, you're basically giving yourself an extra room, extra leverage to basically divide it up into this kind of aspect where, as long as you're consistent, you're not going to over trade or over risk. This is going to be working out for you in your favor. Now let's talk about scenario three now, right? Again, I mentioned the how you want to divide up the money, how much in terms of ratio. It's all up to you, and you don't necessarily need to have 100,000, right? You can have $1,000, and it's the same aspect here. So scenario three, you want to also trade stocks, right? You want to have you want to open a forex account, you want to have a crypto trading account slash wallet, and you also want to trade stocks. Well, best way scenario is just divide into a third, right? So one third for each every single account. So you have 33,000 in forex, 33,000 in crypto, and let's say 34,000 in stock to make it 100%. So scenario is the same, right? You would want to treat all three accounts as if you have the 400,000, and you basically have to risk 3% now per account in order to risk 1% of that $1,000 to that $100,000 trading capital. So all you're doing here is you are spreading out your trading capital so that you can utilize it to your full potential. And you also understand that by doing so, you allow yourself to potentially get into more opportunities in different market, right? Forex market, crypto market, or equity market. You allow yourself to be open or to basically get more opportunity in different market and different situation where you always have the cash available in those accounts to execute positions if the opportunity arises itself. Again, with this kind of situation, I would suggest to balance the account on a monthly basis now instead of a quarterly, because chances are these money will fluctuate on a monthly basis. Some account may be increasing, some amount may be decreasing. So it's best to kind of balance them on a monthly basis, right? Let's say your forex and crypto money, crypto account are all going up, but your stock incurs some losses this month. So it's naturally for you to withdraw from money from the accounts that are profitable this month and then deposit into the account that is losing for the month. That way that you can still try to keep a third of the ratio or 33% in that case for each of the account. And that way you can still comfortably risk 3% on each account. So understand this, you're not risking 3% on $100,000, you're risking 1% on $100,000, even though you are risking 3% in these smaller sub accounts, right? So that is why we're doing this. Again, understand the percentage to allocate, right? It's all up to you. This is just different scenario. You might want to do this, right? With if you just have one account, right? Or maybe you might even want to do two-thirds, right? You might want to have 67,000 in your trading account and you just want to have 33,000 in your saving account. That is totally fine, but you just have to change how much you want to risk per trade now, right? So if you have 67,000 and 33,000 in your saving account, then that means that every trade that you risk in your trading account, instead of risking 1% now, you have to risk 1.5 in order to get that $1,000, which is 1% still to that $100,000 trading account capital. Okay, so as more accounts you divide your capital into, the more risk you will have to trade exactly in this situation. So you might even want to have four accounts. In this case, you might want to put a quarter into your saving account here, right? So that means that every account here is going to be at 25,000. That means it's a quarter of your total account trading capital here, right? So the more account that you divide your money into, the more risk that you need to enter. But at the end of the day, you're still only risking 1% from your 100,000 initial trading capital. Okay, so understand this, that why we do this again is to kind of hedge your risk. Right, you're not putting all your eggs into one basket. You understand that by dividing up the trading capital, whether into different trading accounts that basically allow you to have capital or cash available when the opportunity arises in the crypto market or in the stock market. You always have some cash in there that you're ready to go. You may not be, perhaps you may not be active on a stock trading account, but you have the cash in there. So if anything happens, you are ready to go to execute positions. Okay, so to recap, capital partitioning is very important to risk management because not only you can divide up the cash, that you're not putting all of them into one account, you're basically also utilizing the extra cash maybe in a saving account or buying stocks or in a bond or buying bonds that can generate some sort of a small return. It may not be as a good a return as your trading account, but you're hedging against the risk of your trading account. Okay, or you want to be able to expose to different markets, then you can divide your trading account, trading capital into two different accounts. Right, in this scenario, I put 2/3 in forex and 1/3 in crypto, or you can do 50/50, or you can do in this situation 1/3 or 33% in different cash capitals. Okay, so that is the end of our capital positioning. Personally, I like how you can basically divide the cash into 50% half and half, and you can have the money, utilize that to something else. But the most important, it has to be liquidable, right? That means that it has to be a cash trading account where you can easily deposit or you can easily withdraw in order for you to balance them. So that is it, guys. So any question on capital partitioning, feel free to let me know below, and I will share other risk management video that I've made in the past as well. So check them out if you have any questions, and I will talk to you all next time. Thank you very much.